So, hello everyone. Today we are going to have a very interesting topic to be discussed in our subject accountancy, moving into the class 12 first chapter. And it is a chapter which is from a partnership business. Generally, in class 11, whatever you have studied, the basis were sole proprietorship business, whether you did cash book, journal entries, and all. But in class 12, the beginning is with partnership business, then you move on to the joint stock companies, financial statements, and all are there, cash flow is there. Okay, so in class 11, we are going to extend our final accounts. Now we are going to study about the extension of the final accounts in a partnership business where apart from trading profit and loss account, you prepare one more account that is called profit and loss appropriation account. So in a class 12 syllabus, the whole book is divided into two parts. Okay, the whole main book is divided into two parts, 60 marks in partnership and in a joint stock company, and the other 20 marks is from financial statement. That is also a part of a joint stock company only. Now, here we are going to talk about a partnership business first. Now, what is a partnership business? Now, partnership business is what? Coming together of two or more people with a common purpose of doing business. Okay, which is being carried on by all or any one of them is acting for all and the motive of doing business is to earn profit. And this has been written very clearly in the Indian Partnership Act of 1932, Section 4. Now, the outcome of this act is what? That there must be two or more people in a business. There must be an agreement between the partner, mutual trust and agreement must be there. Existence of business must be there. Motive of doing business is to earn profit. Sharing of profit, yes, the partners will decide that in which ratio they are going to share the profit. Whether they are going to share it equally, whether they are going to share it in any proportion, that has to be mentioned in an agreement. The relationship with the business and the partner is principal and the agent. The principal and agent relationship is there, and the business is having no separate existence. The partner and the partnership business are same, just like a sole proprietor's business. Now, moving ahead, you will know about the rights of a partner. Now, the partners, they have certain rights. If suppose I am doing a partnership business with someone, I have the right to share the profits and losses, whatever the proportion has been agreed by us. Then I have the right to interfere into the conduct of the business. Yes, it's not that if one person has been given the responsibility to carry on the business, the other partner has no responsibilities there. No, he has a right to see the conduct of the business. He has the right to access the business. He has the right to be consulted in the matters related with the partnership business. That means these are the rights given by law to the partners. He has the right to inspect the books of accounts, to see the books of accounts whether there are any frauds or not. He has the right to disallow any admission of a partner. If any partner is to be admitted, all has to be consulted and the consent of everyone has to be taken. It's not that one partner will decide and other partners will accept it. No, consultation has to be done before taking into a new partner. And they are the partners are the joint owners of the property of the partnership. It's not that it belongs to only one partner. No, all the partners are the owners to the property of the partnership. And if the partner is willing to retire, he can do so by giving a simple notice. Now, moving ahead, you will come to know about a limited liability partnership, which we call it as a LLP. It's a very modern concept, not a way back of 1932 or beyond that. No, this concept of limited liability partnership came into the Indian territory, or you can say in Indian country, our country, India. It came into the year 2008 by the enactment of the LLP Act in 2008. It came into force, and LLP is a body corporate. It's not like a general partnership. No, it's a body corporate. LLP has a perpetual succession. Men may come, men may go, but I go on forever. This is one of the characteristics of a joint stock company, that members may be there, members may not be there, but I go on. Created by law and is destroyed or wind up by law only. LLP shall have a perpetual succession. Yes, men may say, men may go. And LLP is totally different from normal partnership. No act of partnership is applicable in LLP. 1932 Act is not applicable in LLP. LLP has their own act, and based on that, the business is carried out. Then you have distinctions between the general partnership. As I said, general partnership in 1932 and LLP means what? LLP means your 2008. So 1932 and 2008, there must be some difference. And the basic difference is what? In general partnership, 1932 Act is applicable in a general partnership 1932, and in LLP, the Act of 2008 is applicable. In general partnership, deed is optional. But here, registration is mandatory in LLP. Compulsory registration is mandatory. Okay. That means registration in normal partnership, not mandatory, optional. It's a body corporate, LLP, whereas general partnership, it's not a body corporate. Separate legal entity is not there in general partnership, but in case of LLP, it has a separate legal entity. Perpetual succession, yes, as I said, normal partnership can come to an end at the event of retirement, death, or dissolution, whereas in the case of LLP, men may come, men may go, but I go on forever. Men may come, men may go, but I go on forever. Number of partners, yes, in a normal partnership, 2 or maximum 50, whereas in the case of LLP, you will have what? Normal 2, maximum unlimited. Ownership of assets, yes, firm cannot own any assets in the case of normal partnership, but in the case of LLP, firm can own assets in its name. Liability, yes, in LLP, liability is limited. Obligations are limited, whereas in the case of general partnership, the liability is unlimited. Deed, the matter of deed. What is deed? What is a deed? It's a written document which contains rules, regulations, names of the partners, all the details related with the partnership. A deed contains everything. Now the question is that what actually the Partnership Act says about a deed. It is not mandatory to have a deed, but for the sake of convenience, the partners prepare the deed, get it registered, so that in future, if there is any disputes, they can fight with the clauses mentioned in the deed. Court also can give its verdict or decisions with the clauses mentioned in the deed. That means the deed becomes a constitution of the partnership. It becomes the constitution of the partnership. Everything is going to be decided by the deed only. If the deed is there, if there is a dispute, if there is no dispute, no problem. But when there is a dispute, in that case only a deed plays a very vital role. Now, importance of a partnership deed, as I said, it's very important document. Okay, rights, duties, liabilities, obligations, all are mentioned in the partnership deed. Okay, who can be admitted, who cannot be admitted, who can retire, who cannot retire, under what circumstances, how to access the books of account, how to maintain the books of account, all the details are mentioned in the deeds. But when you are doing accounting, basically it's a accountancy subject. So when you are doing accounting, there must be certain rules when the deed might not be there. When the deed is there, whatever is to be done, whatever accounting has to be done, it has to be done as per the clauses mentioned in the deed. But if the deed is not there, that means in that circumstances, what has to be done? The first thing the law says, what if the deed is not there, the profit will be shared equally. No partners will be allowed interest on capital. No partners will be charged interest on drawings. No partners will get any salary. No partners will get any commission. Okay. But if any partner has forwarded a loan, in that case, he is going to get interest at the rate of 6% per annum. And the profits, whatever they demand, if the deed is not there, the profits will be shared equally. This is very important. If the deed is there, the profit will be shared equally. Now, from the accounting point of view, if you see what is to be prepared here, you need to prepare the profit and loss appropriation account. Profit and loss appropriation account is nothing but it is an extension of profit and loss account, Okay, all the net profits and whatever the profit from the profit and loss account is brought into the profit and loss appropriation account, and whatever the clauses which are mentioned in a deed, like interest on capital, commission, salaries, reserve transfer, interest on drawings to be charged, all are recorded here. And finally, the divisible profit is given. Now, why we call it as a profit and loss appropriation account? This is very important. Profit and loss appropriation, the word itself says what? Profit and loss appropriation. That means the appropriation of profit and loss will take place only if there is a profit. In the case of losses, appropriation won't take place. That means there won't be any appropriation. Appropriation will only take place when there is a profit. In the cases of losses, there won't be any appropriation. That means what? When there is a profit, according to that, appropriations are going to take place. Now, there is a difference between profit and loss account and profit and loss appropriation account. Profit and loss account is prepared just after the trading account, but profit and loss appropriation account is prepared just after the profit and loss account. And the account has neither opening balance nor closing balance, but here in profit and loss appropriation account, you may have opening as well as the closing balances. Okay, then agreement. Profit and loss account has nothing to do with the partnership agreement. Whereas in the case of profit and loss appropriation account, the agreement is the most important document through which or by which you prepare the profit and loss appropriation account. Now, matching principle, yes, profit and loss account is totally based on what? Matching principle. You have to match everything. Here, profit and loss appropriation account is not based on the matching principle. It is based on the partnership deed. It is based on agreement. Now, change, charge or appropriation. Yes, profit and loss account is a charge. Whether you have a profit or not, you have to pay. Like partner, like to give a rent, to give a salary to the workers. They are the elements of what? Profit and loss account. Appropriation will take place when there is a profit, like partner's salary, like partner's commission, like partner's bonus. That means what? If there is a profit, then only it can be given, otherwise won't be given. But a charge against profit means what? When there is a profit or not, but it has to be given. A liability which is considered as a third party liability also. Then you have concept of charge against profit and charge appropriation of profit. Charge against profit, it is an expense of a business. Whether you earn income or not, whether you generate profit or not, you have to pay it. And appropriation of profit is based on profit. When there is a profit, naturally partners will get. If there is no profit, partners is not going to get. Matter of recording, yes, charge against profit are recorded in profit and loss account, and appropriation of profit is recorded in profit and loss appropriation account. Now, the question of necessary or not is required. Necessary is what? Profit and loss account, from where you can get net profit or net loss. But if you have a net loss, no question of preparing profit and loss appropriation account, because appropriation will take place when there is a profit. And in fact, if there is no profit, no question of what? Appropriation. And as I said, examples like interest on loan. Now, if you take loan from anywhere, you have to pay the interest. The lender has nothing to do with your profit. The lender is not going to question you, or the lender is not going to support you that yes, okay, you don't have a profit this year, don't pay interest. No, the lender is not going to leave you. The lender is going to charge you, and you have to pay. You have to pay to the lender. That is why charge against profit. But partners can say, okay, this year we are not having any income or profits, so don't take salary. They can, among themselves, mutual understanding, they can say no. That is why appropriation will take place when there is a profit. Appropriation won't take place when there is a loss. This is a major difference between profit and loss account and profit and loss appropriation account. In the next section, if you see, you will see the performa of how to prepare a capital account. Now, in this fundamentals, you prepare two ways of capital account. Capital account means the accounts of the partner. One is fixed capital and one is fluctuating capital. Now, when you are following fluctuating capital, only one account, capital account, will be prepared where all the appropriations, all the capital introduction, capital withdrawals are going to be recorded. But when you are maintaining fixed capital method, one account will be capital, one account will be partner's current account. And whatever appropriation has to be done will be done via current account. The capital account will only change by addition of capital or withdrawal of capital. Nothing else, no interest, nothing will be recorded in that. In a fixed capital method, capital balances in the beginning and the capital balances at the end remains the same. It will change or it may change under the situation when introduction of additional capital is taking place or withdrawal of additional capital is taking place. So there is a difference. When you do accounting practically in copies, you will come to know the difference between your fixed capital and fluctuating capital. As I said, number of accounts in fixed capital, you prepare two. One is capital, one is partner's current. And here in fluctuating capital method, you prepare only one account. Okay. And recording of transaction like interest on capital, salary, bonus, whatever appropriation you do in a fixed capital method, you do in a current account. And when you are following a fluctuating capital method, you will record everything in your capital account, not in current account. Then there is other distinctions also. If you see when to prepare, when not to prepare, the question will justify when to prepare, when not to prepare. Okay, fluctuating capital question will ask you, then only you prepare. And the balance might be in capital account. Okay, you may have a balance debit or credit. If you have withdrawn excess capital, you may have a credit balance also. Okay, but current account also shows what? Debit or credit balance. Now, generally, capital shows a credit balance. That means you are having the capital in the business. In a rare circumstances, the capital might be a negative balances also. Then, one most important section is there regarding whole of this chapter, that is interest on loan by a partner to the firm. Suppose a partner has forwarded a loan to the firm. Generally, loan can be taken from anywhere. It's a liability. Interest has to be paid. Even no one is going to leave the interest. But in partnership business, the most important thing is that suppose a firm has taken a loan and the rate of interest has not been specified in the question. In that case, the law says that rate at the rate of 6% per annum has to be paid, and it is not an appropriation of profit, it is a charge against profit. Whether you generate profit or not, the interest has to be paid. The interest has to be paid. So interest on loan. And interest on loan has a separate accounting here. Then interest on loan taken by the partner. Now, if a partner has taken a loan from the firm, in that case, the law is totally silent. If the rate is agreed, according to that, the interest will be taken from him. And it is going to be an income for the partnership firm. It is not an appropriation account. No, it will come into the profit and loss account. It will come into the profit and loss account. So, interest on loan is one of the areas where students basically find some problem. How to treat it, how to record it. This is very important. Generally, what you do, if you prepare profit and loss account, you can show to interest on partner's loan. But when you prepare directly from a profit and loss appropriation account, from your net profit on the credit side, you have to deduct interest on loan by the partner to the firm. Whatever the rate has been mentioned, if so, otherwise 6% per annum. And if you talk about the journal entries, it will be treated just like a normal interest on loan to the loan by partner's account, and then profit and loss appropriation account, profit and loss account debit to interest on loan by the partner. This entry has to be passed. Similarly, suppose a partnership is carrying on the business on a rented property. Now, rented property can be given by anyone, maybe by any partner, maybe by any third party. But suppose if you are taking a property from a third party on a rent, rent will be paid to him. It is an expense for a business. You will show it as a rent in your accounting, in profit and loss account. But if you have taken the property from the partner on a lease or a rent, whatever it is, whatever the rent will be paid, again it is an expense It won't be an appropriation of profit. Whether you generate profit or not, rent has to be paid, and that rent has to be recorded in profit and loss account. And as per IEC syllabus, this rent has to be transferred to capital account of that partner. Again, from the net profit, you have to deduct the rent of the partner. Sometimes, in a very rare circumstances, you find that your appropriation is more than your net profit. Suppose you have a net profit of 50,000 and appropriation is coming to 70,000. Then what to do? Then we have to take only 50,000 and appropriation will be done on the proportionate share of each partner, salary and all whatever is to be given, and you have to take out a proportion and proportionate part will be divided only if the profit is not sufficient and appropriation is more than the profit. So appropriation will take place to the extent of the profit available, that also into the proportionate share, not in whatever they are demanding. No. Suppose we are having 50,000 of profit and appropriation, if you see interest on capital only, it is around say Ram 50,000, Sham 30,000. Now it is 80,000, but you have only 50,000. Now how to give that 50,000? So here you have to make 50:30 proportion. That means 5:3 will be divided. That 50,000 of net profit will be divided in the proportion of 5:3. So these are some accounting portion. Theoretically, if you see, you will understand. There is a concept of drawings against profit and drawings against capital. Very important. Drawings against profit means you are withdrawing for personal use. You are taking it for personal use. And drawings against profit is drawings debited to drawings account. But drawings against capital, this is very interesting. It's a withdrawal of capital. That means you're taking out your capital. It will reduce the capital balances of the partner. It will reduce the capital balances of the partner. And if you talk about interest on drawings, yes, drawings against profit, interest on drawings is applicable. Drawings against capital, interest on drawings is not applicable because it's not a drawings. It's a reduction of capital. But if you talk about interest on capital, yes, that is applicable when it is a drawings against capital. But interest on capital is again not applicable in the case of drawings against profit. So these are certain areas where you have to focus while doing the accounting for partnership fundamental section. Clear? So these are the areas from where you have to deal in the first part. Now you have other parts also where you have to deal with your past adjustments, some rectifications, some mistakes which has been committed and that has to be rectified. Then you have a minimum guarantee section which we are going to discuss in the later section of the chapter. Whenever we will get time, we'll come back again and I'll prepare one again video for you. Till then, thank you very much. Take care.